Picture this. You've got $10,000 sitting in your savings account right now. Maybe it's $5,000. Maybe it's $50,000. And every single month you leave it there, it is quietly losing value. Not because the number on the screen goes down, but because everything around that number gets more expensive. In 2026, the average Australian savings account pays you next to nothing, while inflation eats away at what that money can actually buy. And here's the part almost nobody tells you. The gap between someone who invests properly and someone who just saves is not a small difference. Over 20 years, it is the difference between retiring comfortably and working until you're 70. So stick with me to the end of this video, because I'm going to walk you through the exact order Australians should be investing their money in 2026, from the safest first move to the moves that build real long-term wealth. And I promise the order matters more than you think. Let's start with the foundation, because most people skip this step, and it costs them later. Before you invest a single dollar, you need an emergency fund. 3 to 6 months of basic living expenses sitting in a high-interest savings account, completely separate from your spending money. This is not an investment. This is insurance. Because if your car breaks down, or you lose your job, and you don't have this buffer, you will be forced to sell your investments at the worst possible time just to cover rent. Right now, the better high-interest savings accounts in Australia are paying somewhere around 4.5 to 5% before tax. That's not exciting, but excitement is not the point here. Stability is. Once that buffer exists, the very next move for almost every working Australian is your superannuation. I know it sounds boring. I know it feels like money you can't touch. But super is one of the most tax-effective structures this country offers, and most people are leaving free money on the table without realizing it. If your employer pays you super, check whether your fund allows salary sacrifice. Every extra dollar you contribute this way is taxed at 15% inside super instead of your marginal tax rate, which for a lot of working Australians is 32.5% or higher. That gap compounds. If you're on a decent income and you sacrifice even $50 to $100 a week over 15 or 20 years, the difference in your final balance can be well over $100,000. It's not flashy, but it's one of the highest leverage moves available to you, and it happens quietly in the background while you live your life. The third move, and this is where things start to feel like actual investing, is opening a low-cost, diversified share portfolio. For most Australians starting out, this means index funds or ETFs. Something like a broad Australian shares fund combined with international exposure. You are not picking individual companies. You are not trying to guess the next big stock. You are buying a small slice of hundreds or thousands of companies at once, which spreads your risk and historically has outperformed most people who try to pick winners themselves. The Australian share market has returned an average of around 8 to 10% per year, including dividends, over the long term, and international markets have delivered similar or stronger returns over the past few decades. The key word there is long term. This is not a strategy for next month. This is a strategy for the next 10, 15, 20 years. The fourth move is where a lot of Australians get this backwards, and it's property. Not because property is a bad investment, it's not, but because people rush into it before they've built the foundation underneath it. Property in Australia requires a large deposit, ongoing costs like council rates, maintenance, insurance, and the ability to service a mortgage even if interest rates rise. It can build serious wealth over time, and for many Australians it remains the single biggest driver of long-term net worth. But it should come after you've got your emergency fund sorted, your super working for you, and ideally some experience investing in shares first, because that experience teaches you how markets move without the stakes of a $600,000 mortgage attached to the lesson. The fifth move, and this one gets overlooked constantly, is paying down high-interest debt before any of the above. If you're carrying a credit card balance at 20% interest, no investment strategy on earth reliably beats that. Paying off that debt is a guaranteed return equal to whatever interest rate you're being charged. Clear that first. It's not exciting to talk about, but it's mathematically one of the smartest moves you can make, and it frees up cash flow for everything else on this list. Now here's something that trips a lot of people up. They think investing has to be complicated. Spreadsheets, financial jargon, watching the market every day. It doesn't. The Australians who build real wealth over 20 or 30 years are rarely the ones picking hot stocks or trying to time the market. They're the ones who automate a small, consistent contribution into diversified investments, top up their super, avoid unnecessary debt, and then leave it alone. Time in the market, not timing the market, is what actually builds wealth here. Compound growth needs two things to work in your favor: a reasonable return and enough years for it to snowball. The person who starts investing $200 a month at 25 will almost always end up ahead of the person who starts investing $500 a month at 40, simply because of how many more years that money has to grow. So if you're watching this and feeling like you're behind, you're not alone, and it's genuinely not too late. The 5 moves in order are this. Build your emergency fund first. Maximize your super, especially through salary sacrifice if your income allows it. Start a diversified share portfolio through low-cost index funds, or ETFs. Consider property once the first 3 are solid. And clear high-interest debt before any of it, because that debt is quietly working against every other move you make. Pick whichever one of these you haven't started yet, and take one small action this week. Open the high-interest savings account. Call your super fund and ask about salary sacrifice. Research one ETF. Small, consistent decisions made now are what separate the Australians who retire comfortably from the ones who spend their 60s still worrying about money. Before you go, if you found this useful, this is exactly the kind of breakdown I do every week here on the channel. I'm building this channel, Nexus of Finance, to help everyday Australians actually understand their money without the jargon and without the sales pitch. So if that's something you're after, hit subscribe, because there's a lot more of this coming. If this video helped you see your options more clearly, do me a favor and hit the like button, subscribe to the channel, and turn on notifications so you don't miss the next one. I'll see you there.